As the name suggests, fractional property investing means that instead of buying a whole property, you purchase a fraction of it. This is meant purely for investment purposes. The aim is to receive returns, dividend payouts, or the capital appreciation of the property.
The concept is not new. Large institutions such as sovereign funds, pension funds, high net worth individuals, they actually put money with a real estate fund manager. And the fund manager goes and acquires assets on their behalf.
If it sounds similar to a REIT or real estate investment trust, it is. But there's one key difference. There are currently no REITs with investment in the Singapore residential market. That's why Straits Trading's announcement has sparked interest. It is offering members of its shareholders club an opportunity to invest in part of a good class bungalow or GCB and a District 10 condominium.
For a residential investor, typical residential investors, there are two big things which prohibits them from investing in residential market. One is the capital involvement. The capital outlay is typically high for a high-end residential or a GCB, but this product allows you to invest them in a smaller pieces and smaller chunk, which is more palatable for the investor at this point of time. At the same point of time, investors who are trying to buy a second property or third property in the market needs to pay ABSD taxes, which can be 20 to 30% for Singaporean investors. But going through or investing via this products helps you in optimizing and avoiding some of these ABSD charges which are associated with this residential investment in this market.
However, the Straits Trading product is only being offered to accredited investors, and the minimum investment amount is still quite high, 200,000 Sing dollars for the condo and 500,000 dollars for the GCB. It adds to the diversity of real estate investment options for investors. In 2022, digital platform RealVantage received a capital market services license. This meant retail clients could take part in fractional property investing.
Fractional investing gives you the opportunity, not just different sectors, but different geographies. Right? Now you could be investing into a residential project in Atlanta, Georgia, in the US, or you could be investing into a last mile logistics in Australia, or you could be investing into industrial property in UK. So we want to open our investors' eyes to the playbook in real estate investing. It's not just confined really to residential apartments, right? There's many other ways to make money in real estate, right?
So what do investors need to know before they take the plunge?
Key is the reputability of the sponsor. Better still, the sponsor is a well-known developer or brand in the real estate industry. And secondly, I think the investor also needs to know what assets are being pumped into it. Since it's private equity, better that the sponsor of this scheme bring the investor to the site for a site tour to understand what's going on. And finally, there should be regular reportings on the construction progress and the cost or the costings of the entire project.
They also need to know that although this type of investing looks similar to REITs, there are a few important differences.
REITs are publicly traded, so the liquidity is much more higher, but in this kind of projects it is in a small pool of private investors, so it might be a bit more challenging, especially if the market is in a condition of stress. Finding a buyer, or the liquidity also means that your cost bid spread is much higher. You might be looking at this kind of prices, but the buyer who want to buy might be looking at a much lower prices. So the bid ask spread is a much higher, and you might be facing losses if you have to sell it at a time when the market is really stressed. So the investors who want to take part in this kind of projects should keep in mind that they might need to be in this project for a longer period of time, a 5-year, 7-year period of time before they can realize their capital gains. So liquidity risk and capital risk is something which investors should always keep in mind before considering these kind of projects in the market.
Another risk they should be aware of: the investment product will be subject to the cycles of the property market.
If the real estate market undergoes severe swings and the asset happens to be leveraged to a point where you can't raise money for the asset if there's a crisis and there's credit starvation. The banks, upon the renewal of the term loan, may decide to cut back on the loan, and you may end up with a forced selling of the real estate. The third one is like any other investment. Well, if you have bad assets being injected into the scheme, then you are likely to have bad outcomes for the investors, and that doesn't necessarily apply to fractional real estate. It applies to any other investments too. So bad assets, I think, is a key thing. And how do you know if it's a bad asset or not, or if the sponsor of that scheme injected the assets at an artificially overvalued rate? You then may be you do not know unless you happen to be in real estate.